Welcome to the daily update, where I'll go over the action in the market for Wednesday, February 26th, and we'll see how things look for Thursday, February 27th. Well, we had a nice positive open and we started to go up, but we hit the 50-day moving average, and that pretty much topped things out. We came back down, we actually went negative. We chopped around going into the close and we were up 0.01%, virtually an unchanged day. But because we're slightly positive, it goes in the books as a positive day. Okay, let's go back and talk about what happened. Right at the open, we did have a higher open and prices hit resistance. And then we stalled right about at the R1 level. It slowed things down a little bit, but we went a little higher than that. R1 was at 59.75. And then we got to the 6,000 level, and this is right around the 50 period simple moving average. You have R1 6,000, the 50 period simple moving average right kind of close to each other. So we kind of chopped a little bit, but couldn't seem to break above that. After we chopped around a little bit, we declined back down to the daily pivot at 59.52. We actually dropped below the unchanged level, so we went negative. We fell down to yesterday's S2 level before trying to bounce, but then we chopped around and we closed virtually unchanged. We were up 0.01% on above average volume, just barely. Volume really slacked off, but we were slightly above average. There's real anticipation ahead of Nvidia's earnings being released. That now is the time I record this, they've been released. It's a good report, but Nvidia, last I checked, was down about 1.5%. We are negative in the short and intermediate term because we're below the 20 and 50-day moving averages. So far, the 100 period moving average is offering support. We're above that. And interest rates continue to come down in this general flight to safety, getting out of the stock market into the bond market. At some point, interest rates might be attractive enough to actually get out of the bond market and back into the stock market, but that hasn't happened quite yet. We'll have to see what kind of follow through happens with Thursday's session. And there's a lot of anticipation with the Nvidia earnings. It's become a huge event, and we're up just a little bit with the S&P, but Nvidia's down. So we'll just see. It doesn't seem to be a lot of conviction. We'll see if more conviction develops during the day on Thursday. And then all the different things that are happening within the new administration, with the executive orders, with Doge, with cuts, with the Epstein list supposedly being released soon. We'll have to see how all that goes. And then a lot of different news as far as AI and what's happening in that whole arena. And it's kind of interesting that about the time DeepSeek came out, that's a few weeks back when we had the gap lower open and it caught the market by surprise, we haven't seen any real strength in that area. The mega caps have really been underperforming since then. We haven't fallen apart, but we haven't seen any real leadership in that area. We'll see, are those things connected to each other? And with Nvidia reporting earnings that look pretty good, is that going to produce some more of a positive backdrop for the mega caps and the Magnificent Seven to do better? Okay, just some comments about what happened. There is optimism. Depends on how you look at this. You know, when you say, okay, there's a tax cut of 4.5 trillion over the next decade. Okay, some people say, well, that's great. You know, we're happy about that. It ended up passing through the House. But 10 years, I mean, this is something that kind of comes and goes and then is forgotten. And then, like 5 years from now, people don't remember about this. And, well, you remember that thing that we passed? Well, let's replace it with this. And blah, 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 blah. Or other people are like, hey, this is great. You know, we like this. But it's like when you project things out into the future, you know, there was a lot of things 20 years ago that we shouldn't even be here right now based on some projections with what was going to happen with the climate and things. Well, those didn't end up happening. So then they just projected out into this ever advancing future. Well, the government has a tendency to do that too, where it's like down the road this, down the road that, where at least the people that like what's happening with the new administration. They like that things are for the most part going on right now. I mean, we can see the results that are happening, not we're doing something now that 5 years from now might show some results. And then you have the other side that just think this is terrible, what's going on. But there is some optimism about these tax cut prospects. Okay. And when we try to go up right now, the 50 period simple moving average is acting as resistance, where the 100 period moving average is acting as support. Early gains were given back. I say this over and over. It's the amateurs who open the market, it's the professionals who close the market. Things were looking kind of positive. We were up with the futures about a 0.5%. We did have a higher open. We started to go up after that, but then everything kind of fizzled out. And folks that bought early in the day were suddenly seeing losses by the end of the day. And then we have this whole thing about tariffs going on. There are growth concerns about the economy. We'll have to see. We're going to get another read on GDP. Then we're going to get the core PCE on Friday. A week from now, on Friday, we'll be getting the employment situation report. We'll see if those concerns about economic growth continue or if they start to show some strength. Of course, the diplomatic tensions that are going on with US, UK, Russia, Germany, just a lot of things going on right now. And then this massive number of federal layoffs, where some people think that's great, that we need to really clean house. Other people are like, oh my gosh, you're just taking people's jobs away from them. So it's controversial, but it's what Trump said he was going to do, and it's what Doge was created to do, and now it's starting to happen. So instead of making all these promises and then not following through on them, at least to this point, this could always change, but there's follow through with this. And then the tariffs that have been announced on Canada and Mexico, they're scheduled to go into effect March 4th. So that's coming up. I mean, that's going to be Tuesday in the upcoming week because we're just about finished with February. March 1st is Saturday, and then Sunday, Monday, Tuesday. And then the reciprocal tariffs, like you tariff us, we're going to tariff you. Nah, nah, nah. They're supposed to be implemented starting on April 2nd. It's interesting, not April 1st, not April Fool's Day. All right, then on a short-term basis, we're still seeing the momentum negative right now. Few things fell off the list, but these are the usual short-term indicators that we see when we're leaning either positive or negative. So we have the Stochc RSI, the Williams Percent R, CCI 14 and 20, and the stochastics. This is one thing that I constantly deal with myself, and I want to warn you, and I say this lately in every video. Remember, the bigger picture is still positive. We have a longer term trend that's gone on. It officially went positive in early 2023, but it really started to be created in October 2022 when we hit the bottom. And the reason why I'm saying it wasn't official until early 2023 is that's when we saw the moving averages cross over. The 50 period moving average crossed above the 200 period moving average. But that's the bigger picture, and that still remains positive. So just because we're under some pressure now and the market really hasn't been doing anything, and the only trend that we seem to be developing right now is a negative trend, that doesn't necessarily mean it's going to last a long time because the bigger picture is still positive. That's why we're watching these things. That's why I do the video every day to take a look at all these different areas. We didn't see as much of a defensive posture in Wednesday session like we have earlier in the week. So it's kind of taking a little bit of a breather, but we'll keep an eye on this. And if the market is turning more defensive, then that will turn it longer term negative. But until we have evidence of that, we don't want to forecast or just assume that something's going to happen. So we want to respect the idea that, okay, we're seeing some extreme negative of readings right now with our short-term indicators, but that may not last very long. Okay, and then no real changes to the scenario. We're going to see a Friday with the core PCE coming out. Is that going to change how folks are viewing the Fed and what they're going to do with interest rates, if anything? The dollar was up on Wednesday and interest rates continue to go down. We're seeing more of a decoupling of bonds being seen as a flight to safety. They're buying bonds. That sends interest rates down. We're under the 4.5% level. Where right now we're at 4.25. So we've dropped kind of big in a pretty short period of time. Where after Tuesday we were at 4.3%. And sentiment is still extreme negative. We're under that 25 level. This is where we think, okay, the idea that folks are so pessimistic right now, we use this in a contrarian manner. If everybody's thinking negative, then we start to at least look for things that are positive. Now, we're not seeing that in our charts yet. There's not a lot of evidence in the short term, especially. Things are still holding up okay in the intermediate term, as long as we're above the 100 period moving average, and we're still positive in the long term. Excuse me. And then this is interesting. Haven't seen this for a while. The 10-year to the 3-month yield curve, it's gone back to being inverted again. It was that way for a couple of years. There's two yield curves that the market really follows. The 10-year to the 2-year, excuse me, and that went inverted first a few years back. And then there was a lag time, but then eventually the 10-year to the 3-month went inverted, and it stayed that way for a couple of years, and then we started to go uninverted again. Well, back in Wednesday's session, we're back to being inverted now. Okay, is this some kind of signal that's being sent to the economy that, okay, there's trouble looming ahead? And I do have a chart. I showed this in yesterday's video. It hadn't gone inverted after Tuesday, but now it's back to being inverted. It just means that the 10-year yield is lower than the 3-month yield right now. As far as the trend, we're still negative, and this is a strengthening trend. Now we're still below 20. That's the static line to to determine if we're trending or not trending, but we're above the moving average and the ADX is going up. I'm still keeping the bias at negative mainly because we saw a stronger open and then a lot of give back, and we were virtually unchanged. And I'm keeping the momentum at negative for right now. We'll see if that changes on Thursday's session. All right, we did get new home sales. They were down 10.5% on a month over month basis. And you've got rising prices. And a lot of folks, they're like priced out of the market. And then you couple that with a rise in interest rates. And if people can even afford to buy the house, now they're going to be paying a lot higher mortgage. And that tends to dampen things. When you do an annual rate, a seasonally adjusted annual rate, we're at 657,000 units. And that's less than the 681,000 that had been expected, and down from the 734,000 that we saw last time. When you roll that out on a year-over-year basis, we're down 1.1%. And then every week we get the MBA Mortgage Applications Index. We were down 1.2%. Last week we were down 6.6%. Refinance applications were down 4%, and purchase applications were flat on the week. No change there. So here's a look at the mortgage applications. We do look at this every week. It doesn't really impact the market. I look at this more for economic reasons because if the housing market is strong, that typically means the economy is stronger. So it's down, but down less than what we saw last time. New home sales, this is still going up a little bit here when you look at the seasonally adjusted annual rate. But then when you do the 3-month average of home prices, that's still continuing to go up. Then Isabel Net blog charts. This is again, there's been a few charts lately because the market did so well in 2023 and 2024. You have folks out there that are willing to borrow money called margin to buy more stock. It basically doubles your purchasing power. And we're really seeing this going up. And is that a danger sign here that folks are using borrowed money? Because as I say over and over, it's not a 50-50 split with your broker. If you borrow $10,000, even if you only have $1,000 left, you still have to pay back $10,000. I mean, it's the full amount has to be repaid, and then there's interest on top of that. And the levels are getting kind of high, and that's causing some concern. And then this has two parts, and I know it's fuzzy down here, but I try to blow it up to make it a little more useful because you can't even see the numbers up here. But this is a closer look at weakness after new all-time highs. How do things look going forward? Where we're up 12 times, according to this, out of 30. So that's 40%. So that's not a real good return. But if you look further out, we're up about 70% of the time. 6 months, we drop a little bit. If you go out a year into the future, we're up 80% of the time. So a lot of times after setting all-time highs, and then we see some weakness, which is what we're seeing because last week the S&P set two all-time highs on Tuesday and Wednesday. And then we've been having trouble ever since that really developed last Friday when it was options expiration. And so this chart just tries to say how do things look based on this happening before? How does it look now? And the further out you go, the better it tends to look. And then where's the equity positioning right now? Still into stocks. We're above zero, not at a real high reading right now, but still this is where most of the money is going. The buybacks, the announced, that's the blue line, and then the actual gross buybacks. So they may announce a buyback, but it may end up actually being reality a little bit less here. But that's seen as something positive for the market, a company buying its own stock. And then investors currently allocate more than half of their financial assets to equities. Well, yeah, historically, the stock market has been the place to be. So if people have investments, 54% right now go to stocks. Now, debt, this means bonds, and that's at 18%, where they tend to keep 13% in cash. Okay, then diversification is paying off. This just shows where the you look at China and the equity returns against the US. Well, China's been having a lot of trouble economically, and their stock market was not doing so well. Well, then the government came in and started to do a lot of things that would help that. And so we've been seeing China performing the best, at least lately. And then you have, let's see, this is all compared to the US here. But then it kind of goes down here. And some of these are measured in the local currency, some are foreign exchange. And this is measuring the overall performance against the US. And we're seeing that in some of our charts. And I deal with this in the intermarket analysis video where lately the emerging markets and some of the US markets, and there's even a chart later on that I'll show you, shows that the world stocks have been doing better than US stocks. Now, this is not the longer term trend that we've been seeing. It's what we've been seeing pretty much since the beginning of 2025. And then risk appetite, we're still above zero here. Even though it's coming down, folks are still willing to put money out there that's considered at risk because the risk versus reward. You take a bigger risk, you get a better reward. And then short interest, this breaks it down based on the different sectors. There's 11 sectors in the S&P 500, and then I mainly look at the average here when you take them all together. And then this is what the average was longer term, and it's still very low overall. And the move index, where the VIX measures the volatility of stocks, the move index measures the volatility of bonds. It's relatively new, and so it doesn't have a lot of historical data. So it's been hard to do some back testing with this. But we're just seeing that as bond prices are going up now, the move index has really been dropping off. And I didn't spend any time on X there. And here's the intraday chart showing how we did have a higher open, and then we went up above R1. That was a resistance area. 6,000 is also becoming a resistance area, but then we're also battling with the 50 period moving average, which is right around the high that we set. And we just could not seem to break above that. And then later in the day, then we saw selling take us down negative. We dropped below the daily pivot, chopped around below the unchanged level, tried to go positive into the close, but then ended up coming back down. But we were just barely positive on the day. And we're up. This shows that we're down a little bit, but we're up just a little bit with the S&P futures when I checked right before I started recording. But this is going to change. We've got Europe that's still yet to open, and many hours before the market actually opens when I do the recording here. And this is still turning more negative where we see the blue line below the red line. Value is outperforming growth. Value is red, growth is green, or it should be green. It's blue here. And we have seen a real drop off here with our S&P growth to value ratio intraday, but it did bounce back up in Wednesday's session. So we'll see. Is this the beginning of something or just kind of like a dead cat bounce? Just kind of bumping back up to give people a little bit of hope before it then resumes going back down. End of day, growth was up where value was down. So growth's been getting hit hard lately. So to see it bounce back up, it's not necessarily a surprise, but we don't know if this is the beginning of something or just a little bit of relief. And mid cap growth was also up where value was down, and we were up with small cap growth where value was down. So a little bit of a tick up here with our end of day values with small cap growth to value, but we're still seeing some real recent weakness and a little bit of a tick up with mid cap growth to value and a little bit of a tick up here with S&P growth to value. And a little bit of a tick up here with the growth versus value ETF. We did bounce back up, but we're pretty much in the middle of the rainbow. And a little bit of a tick up here. And you can see where staples, which had been really strong lately, well, we probably saw some profit taking there. And a little bit of an advance, not much, with discretionary. So that helped the overall ratio improve slightly. We're coming back up, but we're not back up to the moving average here with large cap growth ETF. This could be providing some overhead resistance as well. And we are in a negative trend, even though the red line came down, the green line is flat right now. We're above the moving average and we're going up. So this is a negative trend. And we're seeing that same thing here in the short term. So short and intermediate term, the trend is still negative. And we dropped off with volume, but we were still barely above average. And we did get the latest reading from Investors Intelligence, pretty much neutral right now, coming in at 1.8. I mainly focus on this if we get below 1 or above 3. And we are above the moving average with the Ulcer Index. This is another sentiment gauge. We came down just a little bit, but still getting high readings with the VIX, but we're below 20. The line chart is the closing value, and then we have the bar chart down here. And when the VIX falls, typically the VIX of the VIX also falls, and that's what happened on Wednesday. But the momentum for the VIX is still up, which is negative. But the positive side is we're still below 20. Still getting a high reading here with the skew index. This is a variation of the VIX, but we've been up in this red area for quite some time now. A little bit of a discrepancy here. We're declining with this fear gauge, where this other fear gauge is still going up. We declined a little bit with the equity put call ratio on the daily chart, but we're still going up with the 5-day chart and the 10-day chart, and that's more negative. And we're seeing the volatility risk premium continuing to go up above the band. So this is still perceiving some risk yet to come 30 days out into the future. The advanced decline line is still hanging in there. We did see a contraction. This is the new highs, new lows. We did see a contraction of the new highs, but really very few new lows. So our 5 days going up and our 10 days going up. Okay, I got this in the wrong order. The advanced decliners here did decline, but we're still above zero. So this is still leaning a little bit more positive. Here's the advanced decline line. We actually declined a little bit based on price, and we were flat based on volume. And we are coming down with accumulation distribution. Yeah, it depends on your interpretation of this. Because we're coming down, that could be treated as negative. But because we're still above the red line, that could be treated as positive. So it depends on half full, half empty. But then we look at the advanced decline ratio, it's coming down a little bit, but we're still above zero. But then we look at the chicken money flow. This is our second smart money indicator. It's still negative. The red line's going down and the histogram is contracting. And we're still going down with the chicken oscillator. So you could treat all three smart money indicators as negative because the other two are clearly negative. We're negative here with the vortex. The red line is above the green line. And when you look at the S&P, the advanced decline line, we came down a little bit, but we're still above the moving average. We're right on the moving average with the NYSE common stock, under the moving average with the mid caps, and declining below the moving average with the small caps. This is also more negative. This is the Amex, NASDAQ, and NYSE, and then a 5-period moving average of the highs minus the lows. We're below zero. So this is showing some internal weakness. And we decline and we're below 50 with those stocks in the S&P above their 20-period moving averages. and declining but still above 50 with the 50 period moving average steady, and going back down below 50 with the 100 period moving average steady, declining but still well above 50 with the 200 period moving average steady. And we were just right about at the moving average, slightly above it here as far as volume. And now we're getting ready for the March pivot points to kick into gear, which makes this chart a little bit hard to read. We declined with the 20, 50, and 200 period moving averages on the S&P. We're still showing the momentum is negative here with the Stochk RSI. It came up, but we're still extreme with the Williams %R, the CCI 14, and the CCI 20. The condition of the short-term trend, we're below the lines and the lines are going down. And that's showing that the short-term trend is more vulnerable now. And we're below the simple and exponential moving averages, and the lines are going down. That's why we're negative in the short term. We're extreme negative here with the short-term stochastic, intermediate short-term stochastic, and declining but still above the midpoint with the long short-term stochastic. And we're not quite as extreme with the force index, but we're still negative. We're bouncing up just a little bit off the Keltner band. We're still in the -2 channel with standard deviations. And we're coming down and showing some real decrease here with the balance of power. It hasn't crossed negative yet, but it has been really declining. We're off to a no-go now with the purple here, according to the go, no-go system. We're hitting the lower low value here with our highest high, lowest low value chart. We're still below this shorter term anchored moving average, but we haven't breached any of these other ones. The positive side is that these lines are still going up. But we're now turning more negative with the TTM squeeze. We've dropped below zero and we're starting to turn red. And we're showing standard deviation still pretty high. This is just showing that over the last 10 periods, we've seen some pretty significant movement with price. And we're still negative here with the ease of movement below zero, even though we were flat. And we're negative here with the Arun. We dropped below zero with the oscillator. And with the S&P McClellan oscillator, we were actually a little bit positive after Tuesday. Now we're back to being a little bit negative after Wednesday. So we're just kind of barely going down, not really showing a lot of conviction based on price, but we're still declining here based on volume. And we did improve with the NYSE McClellan oscillator, but we're still below zero. My goodness, you'd think I was going through a voice change here. The summation index based on price and volume are declining. We're still declining with the Swinland Trading Oscillator based on price and volume. Momentum is negative. The PMO is going down. We're below the moving average based on price. We're crossing below the moving average based on volume. So a little bit of weakness, but chopping around the midpoint here with the PMOs that are rising. A little bit of a decrease also near the midpoint with the buy signals and starting to trail off a little bit after being flat with the PMOs that are above zero. We're negative with the Elder's Impulse system for the S&P. We're negative with the parabolic SAR since the dots are on top. The momentum in the short term is negative. We're below the moving average and we're starting to cross below the midpoint. The MACD also getting close to that midpoint, but it's going down and is negative. So we're negative pretty much across the board in the short term with the two short-term oscillators. Then I have three intermediate term oscillators. Those are negative, and we're turning negative with our longer term oscillators, the TRIX and KST. And then another momentum oscillator, the Copic curve is also negative and starting to cross below the midpoint. We ticked up a little bit, but we're pretty neutral here with the Sean trend meter. We're declining, but still above 50 with the money flow, or we're dropping below 50 with the ultimate oscillator here. A little bit of a discrepancy. I treat these two as secondary indicators. So one's positive, even though it's declining. The other one's negative now. So, all right. And then this is encouraging, at least for right now. With unbalanced volume, we came down to the moving average and we're bouncing up off of that. Can we stay above the moving average? But we're looking more negative here with the RSI 14 and the RSI 9. The 9 is short term, the 14 is intermediate term. We're still below 50, so that's negative there. The condition of the intermediate term trend, we're still below the blue line and the red line, and now the lines are starting to come down. And we're still below the simple and exponential moving averages here, and now it's acting as overhead resistance. But The 100 period moving averages are acting as support. So we're kind of right in between the two currently. We're below the 20 and 50, still above the 100 here with our moving average tree. We're still declining with the bullish percent index, and we're below the moving average. That's negative. We're below 50 and declining with the NYSE bullish percent index, and just about ready to cross negative with the NASDAQ 100 bullish percent index. And we're keeping an eye on the Ichimoku cloud coming down into the green area. So far, we've been able to stay above that. The green line, it's really hard to see because it's mixed in with the bar chart here, but that's been declining. And the blue line is coming back down to the red line, but they haven't quite crossed yet. If the blue line goes down below, that will be more negative. And we're negative with the Heiken Ashi with the dark candles. We're negative but pointing up with the Kegi chart. We're negative with the Renko chart, and we're negative with the three-line break chart. Long term, just kind of chopping around right now with our 150 and 200 period moving averages. We're still negative in the short term with all the different indexes. We continue to be negative in the intermediate term with the mid caps and small caps. And bonds are positive in the short and intermediate term. Commodities have now switched to down in the short term, where they've been positive across the board. So we're seeing a little bit of weakness there. The dollar has been showing some short-term weakness, but now it's also starting to show intermediate-term weakness. And we had three different sectors that were up. Tech, that's a big growth area, and it was up the strongest, even though it gave back a lot of the gains. Utilities, which tends to be more defensive, and industrials, which is more economic driven, where staples got hit the most because they've been really going up pretty ferociously lately. So there was some definite profit taking there. A lot of red to start out the day. I guess this could be considered positive with the euro crossing below 105. That means the dollar was going above it. But we did see the utilities have a BPI cross below 70. The financial sector is crossing below 50, but it's still in a longer term uptrend. Energy saw a bearish MACD crossover, and then the NASDAQ got up to 19.1, 19.2, but then ended up going down below 19,000. Energy sector, again, had a BPI cross below 50. Is that going to be, because that's been a stronger area lately. If that continues to show more weakness, will that give support to stocks going up? And then we did get back above, at least for a little while, back above 6,000 with the S&P. We're still below the 50-day moving average with the Dow, and we're still negative with the diamonds with the Elder's Impulse system. Looking at the NASDAQ, again, hard to read because of the new pivot points coming in here. But we were up at a quarter of a percent, not all that strong. We were up 0.22% with the NASDAQ 100, but still below the 50-day moving average. We're negative with the Qs when looking at the Elder's Impulse system. The momentum for the NASDAQ 100 is negative, and we're still below the 200-day moving average with the S&P 600 small cap index. And we tried to get above the 200-day moving average with the Russell 2000 small cap index, but we ended up closing down below that. We're negative with the small caps with the Elder's Impulse system. We're still battling it out at the 200-day moving average with the mid caps, so that's holding for right now. And we've gone from negative to neutral with the Elder's Impulse system for the mid caps. We're still below the 50-day moving average with the Wilshire, as well as the total U.S. stock ETF. Financial sector was down, but still above their 50-day moving average. The FANG index is still below its 50-day moving average, even though it was up 1.5%. These are the really big stocks. Apple was down over 2%, almost, well, 2.7%, coming back down to its 50-day moving average. Amazon was up 0.75% after it's been going down kind of quickly here lately. Microsoft is under both moving averages, and we're starting to see a death cross here. Google also under its 200-day moving average. Meta bouncing up off of its 50-day moving average. Nvidia, which just reported earnings, it was up 3.67%. The last time I checked, we were down 1.5%. So we're still above the 200-day moving average, but below the 50-period moving average. Tesla down another almost 4% here. Is it going to come down to its 200-day moving average? Netflix was up 1.31%, trying to bounce up off of its 50-day moving average. And this is what I'm talking about between the US and world stocks. where the red line, that's the S&P 500, which has been under pressure, where the world index that we look at has been going up. And that's why we're seeing the short-term correlation going down and a little bit of weakness here. And we're wondering, is there more of a shift to focusing on world stocks? We've had a number of false alarms with this over the last couple of years, but we want to ask, is this time going to be different? All right, then oil's still under 70 and continues to decline. The dollar, I have it still in an uptrend, but we're underneath the 50-day moving average. And then we're continuing to decline here with the 10-year yield. Are we going to come down and deal with the 200-day moving average? Are we going to drop below that? Or are we going to find some support here and then bounce up off of that? And we're going up with the 10-year based on price. This is the 10 to the 3-month yield curve. We're just barely negative, minus 0.04, but it is inverted. And you can see here where we were inverted in 2020, late 2022 into 2023, and then we finally got back to being normal. Now it's going back to be inverted again. And we're still seeing overall weakness here with our growth to value ratios. Q's to S&P, discretionary to S&P, large cap growth versus large cap value. So the large caps, mid caps, and small caps, even though all three did bounce a little bit, they're still more or less negative. So what's our outlook for Thursday? Nvidia did report, and that's what everyone's been waiting for. We'll see what the follow-through reaction is in Thursday's session. And then we're still negative in the short and intermediate term, and we're still at the early stages of this trend. We're going to get initial jobless claims as well as continuing claims on Thursday. The second reading for GDP, that'll be a non-event if the numbers come in pretty much the same as last time. It could be a big event if the numbers come in different. Durable goods will be coming out as well as pending home sales, and then all the different things going on right now, which could have an impact or may go ignored. And then on Friday, we're going to get the core PCE. That's going to be the really big report that comes out. Here's also a look at the economic reports calendar. Seasonality, we're neutral to negative with the Dow, neutral to positive with the S&P, and flat out positive with the Nasdaq. So take your pick. You've got kind of a buffet here of seasonality factors, and we're still dealing with the week after options expiration, which is pretty much a coin toss. 49 down, 51 up. And now we're coming into the end of February, where even during a regular time or in a post-election year, this is often weak seasonality that can come in. And the second half of February tends to underperform. This also shows the underperformance of the second half of February. February is the worst month in a post-election year. This chart also shows that same thing. So, what are the warning signs? I'm still treating the smart money indicators as more negative for right now, but you could make a case for the accumulation distribution because it's still above its moving average, but it's clearly declining right now. We're going up with the 5 and 10-day equity put call ratios, and now both the S&P and NYSE McClellan oscillators are negative, as well as the summation indexes. Parabolic SAR is negative, the Swell and Trading Oscillator, the bullish percent indexes. The momentum is negative for the S&P. The ease of movement is negative. The ultimate oscillator, the vortex, and the momentum for the NASDAQ 100 is negative. Positive signs. We're still in longer term uptrends with gross versus value, even though it's just been getting hit hard lately. Same thing with discretionary to staples. And the advanced decline line, we're still above the moving average with the S&P, but there are weak areas like the mid caps and the small caps. The money flow is now negative, and the financials, excuse me, the money flow is positive. The financial sector is also positive as well. So the conclusion, we're still negative in the short and intermediate term. We're still at possibly the beginning stages of a negative trend, but we're still positive in the long term. And that's what we're seeing in the short and intermediate term. We're still below that 50-period moving average. I didn't put it on here, but on a positive side, we're still above the 100-period moving average, and we're still positive in the long term. Thank you. I hope you have a really good day, and I will talk to you in the next video.